Alright, so welcome to Hungry for Moat. This is 1964 that we're going to be covering in this episode. I'm with my good friend Prabhat, Avinash, and we are going to be delving deep into the Buffett letters. This is his own partnership, his private partnership, so 1964. Before he starts Berkshire Hathaway. Interesting note about 1964, this is the year that his dad passes away. So if you're a big Buffett fan, you already know he's made some questionable decisions about investments during this year, but and it might be influenced because of his dad passing away. But a sad note, because his dad and him were working together in the same room, the same office. So they were kind of buddies, just talking investments and just kind of working, you could say, as a family business. But ready to delve into 1964.
All right.
Okay. First half performance. The whole family is leaving for California on June 23rd, so I'm fudging a bit on this report and writing it June 18th. However, for those of you who set your watches by the receipt of our letters, I will maintain our usual chronological symmetry in reporting, leaving a few blanks which Bill will fill in after the final June 30th figures are available. During the first half of 1964, the Dow Jones Industrial Average, here and after called the Dow, advanced from 762.95 to 831.50. If one had owned the Dow during this period, dividends of approximately 14.40 would have been received, bringing the overall return from the Dow during the first half to plus 10%. As I write on this June 18th, it appears that our results will differ only insignificantly from those of the Dow. I would feel much better reporting to you that the Dow had broken even and we had been up plus 5%, or better still, that the Dow had been minus 10% and we had broken even. I have pointed out, however, that gaining an edge on the Dow is more difficult for us in advancing markets than in static or declining ones. To bring our record up to date, the following summarizes the performance of the Dow, the performance of the partnership before allocation to the general partnership, and the limited partners' results. So you can see here in this chart 1957 all the way to 1964, the first half. The overall Dow is, do you want to... Okay, so 1957 to 1964, so the first half. So you can see the overall Dow is at about 10.8%, like you said. The partnership is at 27.6%, and the limited partner, so this would be you if you were to be invested, would be 22.2%. So pretty much 2x of what the Dow is getting over the course of the entire set of years. Okay, footnotes on preceding table. Based on yearly changes in values of the Dow plus dividends that would have been received through the ownership of the Dow during the year, the table includes all complete years of partnership activity. For 1957 to 61 consists of combined results of all predecessor limited partnerships operating through the entire year after all expenses but before distributions to partners or allocations in the general partner. For 1961 to 57 to 61 computed on the basis of preceding column and partnership results, allowing for allocation of general partnerships based on present partnership agreements, but before monthly withdrawals by limited partners. So really, he's saying this is what how the Dow performed. This is how me and my family performed, and with fees taken out, this is how you performed. Okay, let's see. Nothing else to really add. You can just see Buffett's kind of kicking butt here. Okay, so buying activities during the first half was quite satisfactory. This of particular satisfaction to me, since I considered the buying end to be about 90% of this business. Our general category now includes 3 companies where BPL is the largest single stockholder, Buffett Partnership Letters. These stocks have been bought and are continuing to be bought at prices considerably below their value to a private owner. We have been buying one of these situations for approximately 18 months and both of the others for about a year. It would not surprise me if we continue to do nothing but patiently buy these securities week after week for at least another year, and perhaps even 2 years or more. What we really like to see in situations like the three mentioned above is a condition where the company is making substantial progress in terms of improving earnings, increasing asset values, etc., but where the market price of the stock is doing very little where we continue to acquire it. This doesn't do much of our short-term performance, particularly relative to the rising market, but it is comfortable and logical producer of long-term profits. Such activity should usually result in either appreciation of market prices for external factors or the acquisition of us and controlling positions in a business at a bargain price. Either alternative suits me. It is important to realize, however, that most of our holdings in the general category continue to be securities which we believe to be considerably undervalued, but where there is not the slightest possibility that we could have a controlling position. We expect the market to justify our analysis of such situations in a reasonable period of time, but we do not have the two strings in our bow mentioned in the above paragraph working for us in these securities. Investment companies. We regularly compare ourselves with the two largest open-end investment companies, which are mutual funds that follow a policy of being typically 95 to 100% invested in common stock, and the two largest dividend closed-end investment companies. These four companies, Massachusetts Investor Trust, Investor Stock Fund, Tricontinental Group, and Lehman Corp., manage over $4 billion and are probably typical of most of the $28 billion investment company industry. Their results are shown below. My opinion is that their performance roughly parallels that of the overwhelming majority of the investment industry organizations which handle, in aggregate, vastly greater sums. Okay, so this is him comparing from 1957 to the first half of 1964, the limited partners, or BPL, along with the other large investment bankers. So you can already see 10% is kind of on average what all the other guys are seeing, but limited partners, 22.2%, killing it.
Yeah, I think that's the only thing that matters is these lines. I mean,
that's
not
right.
going to tell you exactly what's going on.
That's right. And I'm trying to see if there's any year where any of the other guys beat Buffett, and it doesn't seem like that's true. Oh no, that's not true. 1958, Mass Investment Trust and Investor Stock and Lehman did substantially better than the limited partners.
I guess so did the Dow, I guess.
Yep.
Limited partners, but that's okay. That tells you on bullish markets they will do worse.
Yep. Okay, computed from changes in asset values plus any distribution to holders of records during year. From 1964, Moody's Bank and Financial Manual from 1957 to 63, estimated for first half 1964. These figures continue to show that the most highly paid and respected investment management had difficulty matching the performance of an unmatched index of blue chip stocks. The results of these companies in some ways resembled the activity of a duck sitting on a pond, where when the market rises, the duck rises. When it falls, back goes the duck. SPCA or no SPCA, I think a duck can only take credit or blame for its own activities. What is SPCA?
I don't know.
Yeah, not sure either.
Doesn't matter. I mean, basically saying you're just following the pond and the market.
Yeah. The water level has been of great importance for the BPL's performance, as the table on the page indicates. However, we have only occasionally flapped our wings. Okay, interesting. I would like to emphasize that I'm not saying that the Dow is the only way of measuring investment performance in common stock. However, I do say that all the investment management, including self-management, should be subjected to objective tests, and that the standard should be selected a priori rather than conveniently chosen retrospectively. The management of money is big business. Investment managers take great stress on evaluating company managements in the auto industry, steel industry, chemical industry, etc. These evaluations take enormous amounts of work and usually delivered with great solemnity, and are devoted to finding out which companies are well managed and which companies have management weaknesses. After devoting strenuous efforts to objectively measuring the management of portfolio companies, it seems strange indeed that similar examinations is not applied to the portfolio managers themselves. We feel it is essential that investors and investment managers establish standards of performance and regularly and objectively study their own results just as carefully as they study their investments. We will regularly follow this policy wherever it may lead. It is perhaps too obvious to say that our policy of measuring performance in no way guarantees good results. It merely guarantees objective evaluation. I want to stress the points mentioned that the ground rules regarding application of the standard, namely that it should be applied on at least a 3-year basis of the nature of our operation, and also during a speculative boom, we may lag the field. However, one thing I can promise you, we started out with a 36-inch yardstick and we'll keep it that way. If we don't measure up, we won't change yardsticks. In my opinion, the entire field of investment management involving hundreds of billions of dollars would be more satisfactorily conducted if people had a good yardstick for measurement of ability and sensibility applied. This is regularly done by most people in the conduct of their own business while evaluating markets, people, machines, methods, etc. And money management is the largest business in the world. Interesting. Okay, taxes. We entered 1964 with net unauthorized gains of close to $3 million, which is all attributed to partners belonging during 1963. Through June 30th, we've realized capital gains of $2.8 million, of which 96% are long-term, so it appears very likely that at least all the unrealized appreciation attributes to your interest and reports to you in our letter in January 5th, 1964, to be realized this year. I again want to emphasize that this has nothing to do with how we're doing. It is possible that I could have made the above statement and the market value of your BPL interest could have shrunk substantially since January 1st. So the fact that you have large related gains is no excuse for exultation. Similarly, when our realized gains are very small, there is not necessarily any reason to be discouraged. We do not play any games to either accelerate or defer taxes. We make investment decisions based on our evaluation of the most profitable combination of probabilities. If this means paying taxes, I'm glad that the rates of long-term capital gains tax are as low as they are. As previously stated in our most recent tax letter on April 1st, 1964, the safe course to follow on interim estimates is to pay the same estimated tax for 1964 as your actual tax was for 1963. There can be no penalties if you follow this procedure. The tax liability for partners who enter January 1st will, of course, be quite moderate, as it always is in the first year of my partner. For any partner. This occurs because realized capital gains are first attributed to old partners having an interest in unrealized appreciation. This, again, of course, has nothing to do with the economic performance. All limited partners, new and old, except for Bill Scott, Ruth Scott, and Susan Buffett, per paragraph 5 of the partnership agreement, ended up with exactly the same results. As usual, net ordinary income for all partners is nominal to date. As in past years, we will have a letter out about November 1st to partners who have indicated an interest to us that by that time in becoming partners, with the amendment to the partnership agreement, commitment letter for 1965 estimate, or the 1964 tax situation, etc. In the meantime, keep Bill busy this summer cleaning up anything in this letter comes out fuzzy. Cordially, Warren Buffett.
Wow. That's it. Nothing said other than like there's a family's moving to
California.
There's a family trip? Why is family moving to California?
I don't know. Maybe Susie Buffett? Because I thought she went solo though. Yeah. Interesting. What was interesting about this again? I mean, I know we've kind of reiterated this so many times that he's really killing the market compared to everybody. He's doing a lot better, but it goes to show how hard it really is. Like he's talking about these guys who are these investment bankers, and I mean, not investment, these kind of investment managers that manage a lot of money. They find it extremely difficult. If you did nothing and you were just a duck in a pond, just go with the flow, up or down, you'll do perfectly fine. Like us maybe average investors thinking that we can do something that Buffett has done. Clearly, we should take a look at all the other management firms because there's some clear magic here. There's no way that this is possible for the average investor. Would you agree?
I mean, I don't want to say it's not possible for the average investor. I mean, it's difficult and nobody has been able to do it, but all he's doing is following logic, not some sorcery. At least that we know of.
Yeah.
So technically, it is possible, and I think it is one of those kind of situation where if there's an opportunity and if everybody takes advantage of it, it won't exist anymore.
Yes.
Like it becomes more efficient.
Mm-hmm.
And so that keeps an ordinary person from even trying, and the fact that Buffett is smart and intelligent, and do I think I'm as smart as him? Like, is my ego that big that like I'm gonna be like the best investor in the world? I mean, most likely not, but does that mean I should try or not try? I don't know.
I think what it comes down to is like we have to convince ourselves that this is really hard. I think that's my main.
I think it should be the mindset should not be it's easy.
Yeah.
Mindset should be it's hard, and then but it's not impossible.
I would. This is where I think we have our first awesome disagreement, because I would completely disagree that the average investor, regardless of how many 10Ks he studies, if he's an accountant expert and all that stuff, even if you use logic, I feel like there's an understanding of business that Buffett has more than just going off of pure logic. And for me,
is that learnable? That knowledge, is that learnable, or you're saying it's inherent in Buffett? Where
I wouldn't say it's definitely not inherent, but I feel as though it would take an extraordinary amount of dedication and effort and serious. You are pretty much an investor at that point. If you're thinking about emulating what Buffett is doing, your only job in life is to be an investor. I don't think
but there are
you
a
can
lot
have
of
a side
people
job.
like that. There are a lot of people who are full-time investors, investment bankers,
but they're not.
Don't do anything close to what Buffett does.
Yes, yeah. Well, we know from the numbers already. Yeah, that's very true. But I'm saying
And
if
still there are people like Munger
yep,
who are doing random things of their own, and they find their way to Buffett.
I wouldn't. Munger's an unfair comparison. He's another alien. I don't think that's a fair one.
Yeah, I also think I don't know if Munger was. Do you think Munger was as good investor as Buffett, or was Munger better or worse?
I don't think he was better. I'd say he's maybe on par, but
He's probably slightly worse. But
yeah.
I think Munger was not 100% about investing. He had other things going on in his life.
Yes, that's what I was just about to say. Buffett is not as well diversified as Munger is, for sure. So if you're comparing like individuals like Munger, or maybe Pabrai would be there, maybe Leila would be there, all these fantastic investors. If you compare them, those guys, everyone that mentioned there, are all hardcore value investors. So if you're from the grand camp, I feel as though you have a better shot of beating the S&P than if you were to be just a money value funding, person like, I don't know, Lehman or something like that.
Yeah. I think even Leila mentioned, I think he's probably more like Buffett than Munger. Just because we don't know anything about Leila. and I think all he does is invest.
Yes, I think that's true. And in fact, Munger has been quoted saying that Lilu is the Chinese Warren Buffett. So it's interesting.
It's funny because I think Lilu has a much better relationship with Munger than Buffett.
That's true. Yeah. I mean, actually, they're very close buddies.
So does Buffett. I think Buffett has a better relationship with Munger than Munger. You know.
That's some meta stuff, man.
And interestingly, his dad died in April, so he has already passed away. And,
Wow, interesting.
And you know, like maybe that's why this is such a. And he's already, you know, it's a muted letter.
Yep.
And I think he's already kind of done a hostile takeover of Berkshire Hathaway at this point.
Yeah, that might be true. And there's no appendix to this letter, is there?
No, but he didn't. This was all about. There's like no insight into what he's doing.
Yeah.
This is all just kind of his routine.
Yeah. Bummer. So there's no appendix to this one.
Let's just do the.
Yeah.
Wait, that's let's just do the January one as well.
Okay. Yeah. Let's do that. In a new episode, or do you want to continue here? This should still be. Yeah. Okay. Let's.
Whatever you want.
Yeah. Let's restart then. Thanks. Okay. So let's. This is it for 1964, and so.
Well, no, that's 1960 with the first half. Now we're gonna do the second half.
That's right. Yeah. Second half. So next episode. See you there.